how do you explain a weak dollar, given where we are with Fed trying to raise rates?
Well, I think that if the Fed is raising rates from crisis levels and lower levels, if interest rates start to go up from these types of very, very low levels, that's actually a good thing because that means the economy is improving. If the Fed is increasing after a period of increasing where the economy is overheating, that's when you start to worry more things. So we're heading into a period of cyclically higher rates, not structurally higher rates.
And what's important here, and Joe, Brian sets us up perfectly for this observation. Folks, this is CFA level 4 for those of you cramming for the CFA Institute exam, the risk-free rate. So if Brian says optimistically rates are going up is a good thing, there's the nominal rate, there's the inflation-adjusted rate, and they fold into our anchor, the risk-free rate. Do you have a clue where the risk-free rate is right now?
Well, we're trying to find our way as we normalize interest rates here at home and overseas. And I think to Francine's point about the dollar, it's not that the dollar is weak. I think the other currencies are looking stronger. The ECB is ready to stop tapering. They're ready to tighten later in 2019. And really, Tom and Francine, the key is there's just so much liquidity out there. Every client I speak to,
there's just a wall of money.
So much money. They don't want to pay up, but they don't want to miss a day when there's green on the screen. So I think kind of rolling off this money, absorbing all this cash, it's another 12, 18 months.
Right.
It's going to roll in equities.
When you look at the wall of money out there, it comes down to internal rates of return. If we move the IS curve with fiscal stimulus and tax cuts twice to the right, if we have a president who says, make America great again, do you just assume IRRs go up and that lifts up private equity, lifts up venture capital, and lifts up somebody with $42,000 in their 401k?
To some degree, I mean, going back to the dollar as well, is that the dollar typically and historically rallies before interest rates go up, and that's exactly what's happened. Now that interest rates and fiscal policies beginning to hit, the dollar is weakening. That's all about where the economy is going longer term. Yes, rates of return are going up. The biggest thing that people are missing right now is we're so focused on inflation. We should worry about growth, and that's where the internal rates of return of these companies are going to be going up. And we started this whole conversation about cash. Cash is awesome, and you want to find those companies that are deploying cash in a very meaningful way, not just because of dividend growth or buying back stock, but CapEx. And that's the next part of the cycle that you think many people, investors, are missing.